Okay. Hi everyone. Okay. Today we actually I have to go to the countryside for work, so I need to record the video for you guys to study for this video will replace to the class of 11 March. Okay, 11 March. So we continue with the chapter 2. Okay. Started with the chapter 2. I think I should. Okay, principle, the course is principle of accounting. Okay, we continue with the chapter 2 is about the generally accepted accounting principle or GAAP. Okay, the chapter focus is who are the SEC or AICPA or FASB. So who's is the like the organizer or the agency of that. And then second, we need to understand about GAAP or generally accepted accounting principle. So this one is what it is. So we will focus on this chapter. It is important that you should understand the concept of GAAP or generally accepted accounting principle, which form the basis of the accounting or other parts of the language of accounting and business. So this chapter will introduce the agency responsible for the standardize of the accounting principle that are used in the United States or in many countries around the world. That will describe those principles in the full idea in this chapter. Once you understand these guidance of the principle, you will have the solid foundation on which to build a complete set of the accounting skill. And it's useful and necessary that the whether an international company is reporting to its stockholder or the proprietor is represent the information into to the bank for getting loan, and this report will follow a consistent set of the rule that everyone understand and agree to do. Okay, who are SEC, AICPA, and FASB. So this one is like Congress creating the Security and Exchange Commission. So this one is SEC. So they created in 1934. So this one is under the U.S. situation. At that time, the commission was given the legal power to like prescribe and prescribe the accounting principle and practice that must be followed by the company that come within the like legislation. And GAAP or like this one is like the general like speaking to understand the company come under the SEC. SEC is the Security Exchange Security Exchange Commission or SEC regulation. The company which come under the SEC regulation when they are sell the securities to the public and list of their security on any one of the security exchange, for example like the New York Stock Exchange or American Exchange. So and many exchange markets. So this one is at the security that exchange in the market. So when they come greater a specific size and measured by the firm asset and the number of the shareholder. So SEC had the power to determine the official rules of the accounting practice that must be followed by almost all the company of the any like significant size, and instead of the for the most part of SEC assign the responsibility of the identifying or specify the GAAP to the American Institute of the Certified Public Accountant or AICPA. So that rules has now been transferred to the Financial Accounting Standard Board or FASB. So all of the rules from FASB are considered to be the GAAP, and FASB is like currently collaborating on the project with the International Accounting Standard Board to make it easy for the company to report the financial statement, so that it separates the so that the separate statements are not needed for US and for the international market. And a firm must be adopt the like accounting practice recommended by the FASB or SEC, unless they can identify the alternative practice that has the substantial authoritative support, and even when the company can find a substantial alternative authoritative support for the practice is used with the differ from the one of recommended, the company must include the financial statement footnote or the auditor report as in the report, and the statement identifying that the practice used are not for one recommended by GAAP, and where practicable, the company must explain how its financial statement would have been different if the company has used the GAAP or generally accepted accounting principle. Okay, we talk about more detail about the GAAP or generally accepted accounting principle. So the all of the financial statement must present the relevant, reliable, understandable, sufficient and practicably obtainable information in order to useful. So the first one is other relevant information. So the financial statement should be the relevant information. For the relevant information is that the information which help the financial statement user estimate the value of the firm or evaluate how well the firm is being managed. So the financial statement must be say in terms of the monetary unit, since the money is our standard mean of the determining of the value of the company. So for the accountants use the stable monetary unit concept, which means that even though the value of dollar change over time, the value that appear on the financial statement normally are present at the historical cost. Okay, what is the historical cost is the historical cost represent the information on the financial statement that amount the individual or the company paid for them or agreed to pay back for them at the time of the purchase. So this method of accounting ignore the effect of the inflation that maybe maybe the dollar is changed over time, so that will affect the inflation. So in many other countries throughout the world, the accounting profession do like do account for the inflation, but for US is not affect because they use the financial statement that represent at the historical cost. So this one is like the normal to understand. And not all information about the firm is relevant for the estimating its value or evaluating its management. For example, you don't need the information of how many individual over the like 40 years of age work of the for the company, or what color the machinery is painting in order to make the financial decision about the company, because it's very important, more important than that. So even some financial information is not relevant, like how much money the owner of the corporation has in the bank, because we will as the chapter 1 you should know that the business account with record we kept separate from the owners, so the owner financial information is irrelevant to the business accounting record. For as a part of convergent project discussed, so um the FASB has like started transitioning from the principal historical cost to the fair value, with the fair value asset would be shown on the balance sheet at what they could be replaced for, or at the value that had been appraised. This that normally would be a value higher than the historical cost or the amount paid of the asset by the company. Like the many accountants agree that this value better represent the true value asset on the balance sheet. So the next one is reliable information. For the reliable information is the key in the accounting. For the sufficient and the objective evidence should be available to indicate that the information represent is valid, and the information must not be biased for like in favor of one statement user or one group of user to detriment of other statement user. And the need of the reliable information has caused the federal government to pass the laws requiring the public companies to have their records and their financial statement examined or audited by the independent auditor who make sure that what company report is accurate. And the next one is verifiable. For the need of verifiable information does not like preclude of the use of the estimate and approximation. If you were to eliminate from the accounting or estimate, the result of the statement would not be useful because the statement will not provide the sufficient information, and the approximation that are used that cannot be wide guess. They must be the base of the sufficient evidence to make the result statement reliable basis of the evaluating the firm and its management. For example, for a page in the financial statement where we estimate the value with the depreciation, for once we purchase a long-term asset. Long-term asset is anything that the company owns that with the last longer than 1 year is the long-term asset. For example, the building. Then we can need to separate the cost of this building over the life of asset. So this one is how you how how they calculate as the cost of the building or over the whole life of this asset. So it's called as the depreciation. In order to do this, we must estimate the life of that particular asset. We can't know exactly how actually we can't know exactly for how long that will be, but since we do have the experience with the types of asset, we can estimate the asset life, and we assume that the building will be usable for, like, let's say 20 years, and depreciation of the cost of building over the 20 years. So it means like depreciation is the spread, like spread of the cost of the building. So the building is called as the long-term asset, and over the depreciate of the cost of building over the 20 years. So let's say as the 20 year as the estimate the whole life of that building, of that long-term asset. So for example, if we buy this building as 100,000 $100,000 and assume that it's going to the last 20 years. So it means that the value of the building is 100,000, but for the estimate life of the building is 20 years, and annual depreciation will be 1,000 per year. So how you calculate it? I already calculated for you in parentheses. So this is parentheses. You calculate at the $100,000, but divide with the estimate life of that asset, so it's 20 years. So you 100,000 multiplied by 20 years, you will get 5,000. So this $5,000 become one of the expense of the company that is shown in the income statement along with the other expenses. The next one is the understandable information. For to be understandable, the financial statement must be comparable. So any item on the balance sheet that the accountant label or as the asset or the liability, use of the user of the financial statement should also call at asset and liabilities too. And the statement user must compare the financial statement of the various firms with one another, and they must compare the statement of the individual firm with the prior year, like prior year statement of that's the same firm, in order to make the valid decision. So the accounting accounting practice that a firm used for the particular transaction should be the same as the other firm used for the identical transaction. So this practice should also be the same practice the firm used in the previous period. So this concept is called as the consistency. So together, the information that are comparable, also consistent, become the understandable to the user of the financial information. The next one is quantifiable information. For the information, it's easier to understand and use it if it's called like quantified. Most of the information that accountant and user of the financial information use is represented by the numbers. Quantify is mean in the numerable unit or by the number. The information that present in the financial statement is present in a numerical form. So it's in the number, and where that is impossible, the information will be present in narrative form, usually in the footnote in the financial statement. So they will have footnote and under and as the narrative form to be more understand. Okay, we will talk in the detail of each financial statement later, but you should know that they will have as the numerical form, as the number form, as the number, but they also have the narrative form to make sure and understand, the user of the financial statement can understand the audit or the accountant that make the report, the financial report wants, like the other to know that what they are represent to, and the accountant include the narrative information along with the quantifiable information because of the need of the adequate or the full disclosure, and the statement user must be sufficient the information about the firm. For example of the non-quantifiable information that might be included in the footnote to the financial statement would be the detail of the outstanding patent infringement lawsuit against the company that would be the consider a contingent liability. So this one is the example of non-quantifiable. And the next one is obtainable information. Like to be useful, the information must be reasonably easy to obtain. So this is fit into the concept of the cost and benefit. So the information must be worth more than what is will cost to obtain it, and must be secure on the timely basis. So the financial statement must be prepared at least once a year. In many cases they may be quarterly or monthly, but at least once a year, so it's annual. And they attempting to incorporate the unobtainable information could seriously delay the schedule. For example of the obtainable information is the number of the shares sold by the corporation during the year. So another example would be amount of the sales by the business during the year. And an example of information that might not be considered obtainable would be the nitty-gritty details of the pension plan system used in each of the subsidiaries of the multinational corporation. So this one is not considered as like nitty-gritty detail of the pension plan system, will not consider obtainable information. But more reasonable and easy obtainable piece of the data might be total amount of the money that be spent on the company pensions around the world. So this one is about the obtainable, and this one is about more concept about the entity concept. The example of the obtainable information is the number of the shares sold. Number of the shares sold. The financial statement must be also present information representing each separate entity, or they can call at the entity concept. In other words, the transaction of each business or each person are kept separate from those other organization or individual, and the transaction of the subsidiaries of the multinational corporation must be kept separate from the other. And even though at the end of the year, the record of all the subsidiaries must be consolidate into one of the set of the financial statement. The record and the transaction of each subsidiaries will kept separate during the year. And the next concept is about going concern. It is normally assumed that the company will continue in the business into the future. It means that if you own the business, so you hopefully that the business can run through and well done in organization and have a good profit. So this one is have you also hope that the company will continue the business into the future. So this one is going concern. This concept is called as the going concern principle. So there are several estimates that you make in order to complete the financial statement representation. And if you did not assume that the company was going to remain in the business in the I did like indefinite the future, you could not use this source of information as a going concern principle. The alternative of the going concern principle is to assume that the management plan is liquidate the business. When this is known for sure about the business and a different set of the accounting principle and the rule are used. In general, when a company liquidate, the assets of the company will be listed at what they can be sold at the return rapidly, and this amount will be below the value state on the balance sheet that since we be sold at the fire sale price. So this one is for example as a condominium. So this one they will have a fire sale price to that they sell before the condominium construct like the whole complete. But for fire sale can normally it's used to the sale that early price or early bird or fire sale price. So this one normally is below the level of that the real like the real value of that asset. So this one is an example. And the realizable value, so the asset normally are not shown on the balance sheet as more than either the historical cost or the amount of which they can be sold below the historical cost. For example, to understand this, if a company has inventory, so this one inventory that lists at the historical cost as 100,000, but due to the economy and the competition and have the new or maybe have the new technology coming, so now today it's only worth at 8,000. So these assets will written down and show on the balance sheet at 8,000. So the section of the conservatism shed the more light on this topic, and the example of exception of this rule is the marketable security or the stock. This asset will show on the balance sheet at the current market. Okay. And sorry, I think this one is for like in US, for the purpose of preparing the financial statement, the accountants are not allowed to write up the asset to the value higher than the historical cost. This one is under the GAAP. And this is not true for all country of the world, where countries may argue that if you can write down on the asset reflect the reality, why not do the same when the asset increase the value? But in many countries outside the US, the accountants are around to write up assets when they are increase the value, reflect to the market value, as well as write them down when the market value is lower than the historical cost. So this is important point to keep in mind when when you reviewing the financial statement prepared in the company, like our in or outside the United States. Sorry. So if the company that are in the United States, so you record or write like the transaction as under the historical cost concept, but the outside the US, maybe some country will record as the market value or the like the real price in that point of time to record. So this one you should like keep in mind that you should when you review the financial statement, the company is located inside US or outside. Okay, they have their own rules to the financial statement to report. Okay, and next one is materiality. So this one, the financial statement data must be simple and consist as possible. So the item is considered material when its inclusion or exclusion in the financial statement would change the decision of the statement user. Like the rule of thumb is in the accounting might be that the item was like 10% of the business net income is considered the material should be reported in the financial statement, that there is no firm dollar about the to be followed here, but an important factor to remember is whether the amount in the question will change the user decision. So this concept is called the materiality principle. The items that are not the material should not be included on the statement separately. And if this item were like included in the financial statement, they would be obscure the important item of the interest to the reader, and then the many immaterial items should be grouped together and called as the miscellaneous, or the item that could be added to other item that so that the total becomes material. And the item can be lumped in together with other items that are material, and that entire bundle can be considered the material. So this one is the materiality concept. The next one is conservatism. Another traditional practice that the accountant should use to guide them in the preparing the info like the financial statement is called conservatism. When even two or more accounting practice appear to be equal, suitable to the record of the transaction under the consideration, the accountant should choose the one that result in the lower or the lowest asset figure on the balance sheet and the higher or highest expense on the income statement, so as it not to be overestimate about the financial event. So this principle of accounting is highly controversial, since it while being conservative, we may be violating other general accounting principle or GAAP, like the consistency, and it also often asks like why is the lower value better if the higher value represents the true value of the asset. So for example of the conservatism principle in action, it might be represent the inventory, maybe inventory on the balance sheet. So there are several different like GAAP that are allowed to assign a value of inventory, and the accountant should choose the one that represents inventory at the lowest value, so as the not the overstate the principle this principle as uh this particular asset. So the accountant will choose the one that represent the lowest cost to not overstate of this particular asset, and the conservatism idea will is misused when the accountant choose the practice that is not suitable to the situation, as the alternative practice merit to the report lower asset or higher expense. So this chapter is also a little bit short, but you need to review and understand this one also, the main concept or like the principle to accounting principle to understand as the basic. So you need to understand all of this as the first chapter is about like introduction to get to know you get you to know and understand about the principle of accounting, as you need to understand the financial statement. They have four of financial statement: income statement, balance sheet, statement of retained earnings, statement of cash flow. So this one about chapter 1. But the chapter 2 is more about the GAAP or general accepted accounting principle, or the rule or standard that accounting or accountant need to follow to make the annual report or make the financial statement. So this one you should understand. For this and this one is costly to like the vocabulary and the meaning of that to easy to review. Okay, for the AICPA is American Institute of Certified Public Accountant. So this one is the professional organization of the accounting profession. This group has responsibility to set the ethic regulation for the profession, as well as writing and grading the certification public accountant examination. So this one is if you are the bachelor in accounting but you want to be the accountant, so you need to pass this one CPA examination. Okay, so this one is conservatism principle. So this one is one of the principle that you should know. Even whenever two or more accounting practice appear to be like equal suitable to the transaction under the consideration, the accountant should always choose one that result in the lower or the lowest asset on the balance sheet, but choose the higher or highest expense on the income statement. So this one is under the conservatism principle. And the next one is consistency. Is the practice and method used for the presentation of the financial statement should be the same year to year, percent to percent. If they for any reason of the company and their accountant decide to change the method or presentation for any item on the financial statement, they must present a footnote to the financial statement explain explaining to explain why the method were changed, so you can understand under the footnote at the narrative form. They will show why how they use the method to present. Okay. And the next concept is entity concept. This one is the principle that require the separation of the transaction of each business or each person from the other organization or the individual. For example, when a company owned by one person, so the personal finance of the individual who own of the company are not included on the company financial statement. So opposite is also true as the financial information of company will not include in the financial statement of the individual owner. So this one is entity concept. And the next one, next two is the financial accounting standard board. So this one FASB. So FASB who set the accounting standard to be followed by the for the preparation of the financial statement. For all rule of the FASB will consider to be the GAAP. And what is the GAAP? GAAP is the generally accepted accounting principle. So this one is the GAAP. It's the standard set of the accounting rules used in US and prescribed by the various organizations like FASB or SEC. This rule will guide the uniform of preparation of the financial statement. The next one is this slide is about all about the principle. The principle is going concern. Going concern is mean like the principle assume that the company will continue in the business into the future. Like without this assumption, most of the accounting information could not present in the financial statement since we like always making assumption. Like one only way to make this assumption is the further assume that the business will be is existent into the indefinite future. So this one is going concern principle. And the next one is historical cost principle. So this one according to the rule of historical principle, most assets and liability should be represented on the balance sheet at amount that paid to acquire the asset or the or for the liability at the amount that was contract to be paid in the future. So not the account is taken either the inflation or the change of value of asset over time. So the inflation or deflation not effect for when you use the historical cost of principle because they record at the price that had paid or the acquire of the paid to acquire the asset at the at that amount like as a historical cost. And the next one is like materiality principle. So this principle state that the item should only be the include on the balance sheet if it change the decision of the statement user. For example, if the multi-million-dollar corporation were to donate 100 to the charity, so this information would not change the decision that management or the owner would make because like it's only 100 but the value of the corporation is multi-million-dollar. So let's say, so this one is since the corporation money was spent, but this distribution of 100 must be combined with like other small expenditure or reported as the miscellaneous expense. The next one is obtainable information. For obtainable information is the information reported in the financial statement must be accessible in the timely manner without the unreasonable expenditure of the resources. For example, the time, the effort or the money that to be included in the financial statement. Okay. The next one will be the quantifiable information. The information is easier to understand and use if it's quantified. So it means that when the information cannot quantify it, but it's still relevant to the user of the financial, it must be shown in the financial statement in narrative form in the footnote of the financial statement. And the next one is like realizable value principle. So this one is these indicate that the asset should normally not be shown on the balance sheet at the value greater than they can bring the company if so. So if the original historical cost of the example is 5,000 and the maximum of the company can sell that asset for today as 4,000. So this asset should be shown on the balance sheet at the lower amount because this principle. So under the realizable value principle, the asset will shown at the balance sheet as selling price as 4,000. So for this one. And for the relevant information, the information reported on the financial statement must be relevant in that they help the statement user to estimate the value of the firm or evaluate the firm management. But not all information about the company is relevant to this decision making. For example, maybe the number of the women employee and the number of men employee that currently employed at the company would not be considered as the relevant, even though it might be important data to other contexts, but this type of information will not include in the financial statement. Okay, and the next one is SEC, Security and Exchange Commission. So this one is the body created by the Congress in 1934, and this is one of SEC duty is to prescribe the accounting principle and practice that must be followed by the company that come within the its jurisdiction. And this one also the principle as the recognition. For this is the process of recording the revenue into the financial statement. For the revenue is recorded at the point of transfer of merchandise or service or goods and service, but not at the point of receiving cash. So this one is how revenue record. It means that once the service is provided for which a charge of has been incurred, that service should be shown on the financial statement regardless of the whether money is actually changed hands. So similar to the expenses that recognized when incurred, not when the money is exchanged for that particular expense. So this one is the under the recognition principle. And reliable information is they should be the sufficient and objective evidence available to indicate that the information present is valid. So this one is reliable information. And the separate entity is about the entity concept. So it means that even the company has the one of the owner, but when you record as the financial statement should separate as the business financial statement and the individual financial statement. So this one is under the separate entity or entity concept. And the next one is stable monetary unit concept. So this one is about the even though the value of the dollar change over time due to the inflation deflation, the value that appear on the financial statement in US normally present at the historical cost and don't take any inflation into the account. The next one is about understandable information. So this one is the financial financial information statement must be comparable and consistent if one of the accountant call a particular item as the asset. The accountant must follow the set of the rules called GAAP to arrive at the definition of that asset. So when any user of that financial statement read that statement, he will understand the meaning of the asset and how they classify that asset. So this one is understandable information. And the next one is verifiable information. So this one is the information on the financial statement must be based on the sufficient evidence that can be substantiated and provides the reliable basis of the evaluating the firm and its management. So this one is verifiable. That's all. And that's all for the whole chapter of the chapter 2. It's mostly about the principle and concept of the accounting and under the GAAP or general accepted accounting principle. So this one you should understand. And you have the assignment 2. The question is the owner of the business decide to write up the value of their land. Okay, what is the land? Land should be the long-term asset of the company, which 10 years ago cost at $10,000 to purchase and today sit in the prime location of the city. So this land has been priced at 40,000. So, as the accountant, should they value their land on the balance sheet at the value of 10,000 or 40,000 and why? Okay, this one is as the assignment 2. You should send me by email. The same as the assignment 1. For the assignment 1 I already checked. You guys have I already received for like all of you. Okay, but for this assignment should be the same as you answer the question as they should value the land on balance sheet at 10,000 or 40,000 and let's say why you should that, and answer to my email, the same email beny.wh@ssru.ac.th. The deadline before today midnight. Okay, is today midnight. It means that you should send me before like 11 March midnight. It means that before today midnight. Sorry, I forgot to change this one. So it should be you send it before 11 March midnight with the email title again, because I think I need to see at the topic. Okay, this student is already sent to me, so I will easier to check for the assignment. You said at the email title at the assignment 2, following with the student ID and the name. Okay. um Once again, so this still will be the basis of the principle of accounting. So the first chapter will be the financial statement. You should understand the type of financial statement. But for this one you should understand the concept when they record or do the financial report. So this one is the main concept to understand. The main concept and main principle they use in accounting, but it depends in country, maybe the laws and regulation, and maybe under the GAAP as US. For like as US, they use the like the historical cost but not the market value. But for the other, maybe use the market value more than the historical cost. So it depends. Okay, it depends. So this one you should you should answer this one as assignment 2. Okay, if you have any question after you listen the learn this chapter, you can contact me anytime by WeChat. Okay, maybe by WeChat easier, maybe directly to not disturb the other teacher or other student. Okay, but please feel free to contact me if you don't understand anything. Okay, so that's all for today. So see you next week. Okay.